Right now, the biggest used car crash in US history is unfolding, and it's about to wipe out billions in family wealth. 3 million vehicles are about to flood the market, setting off what industry insiders call a used car apocalypse. For regular buyers like Jason in Detroit, it means overnight losses of $13,000, while Phoenix drivers like Maria watched their trade-in offers plunge by $11,000 in just 12 weeks. But what's really fueling this collapse isn't just too many cars, it's a hidden dealer financing crisis, margin calls, and desperate decisions behind closed doors. How could so many people lose so much so quickly? And why has almost no one warned you before now? Jason, a welder from Detroit, signed the paperwork on his Ford F-250 last year for $64,000. The payments were steep, but he figured the truck would hold its value. 12 months later, he drove past the same dealership, same model, same trim, same year, now listed at $51,000. That's $13,000 gone in a single year. Not stolen, not crashed, just erased by a market that turned overnight. For Jason, the reality hit hard. Every payment he made was sinking into a vehicle worth less and less by the week. Maria, a nurse in Phoenix, faced a different kind of shock. She'd planned to trade in her 2021 Honda CR-V, hoping to upgrade before the miles piled up. 3 months ago, her local dealer offered $22,000. By the time she was ready to make the move, the offer had dropped to $11,000. That's an $11,000 loss in less than a season, more than her entire annual grocery budget. Maria's plans for a new car vanished. She's now stuck with a vehicle she can't afford to sell, and a loan balance that won't budge. Stories like these aren't rare, they're everywhere. 40% of recent buyers now owe more than their cars are worth. Some are upside down by $7,000, $10,000, even $15,000. The numbers don't just hurt on paper. Jason's refinancing options disappeared. Maria's monthly budget collapsed. Negative equity isn't a theory, it's a trap. When prices were rising, cars felt like assets. Now, they're liabilities dragging families underwater, one payment at a time. For many, the losses are invisible until it's too late. Trade-in offers that once felt generous now come back slashed in half. Dealers, desperate to unload inventory, aren't making up the difference. Lenders are tightening up, and those who rolled old debt into new loans are watching the gap widen every month. The wealth transfer is real, and it's happening in silence. People like Jason and Maria aren't just losing money, they're losing options, mobility, and peace of mind. The crash isn't just numbers on a spreadsheet, it's families watching their savings evaporate, workers stuck in cars they can't sell, and buyers realizing the American dream of car ownership can turn into a nightmare with a single market swing. Every dollar lost in negative equity is a dollar that won't go to college savings, retirement, or even next month's rent. The pain is personal, the consequences are real, and for millions, the impact is just beginning. Most people don't realize that nearly every car on a dealer lot is actually owned by a bank, not the dealership. Dealers buy their inventory using what's called floor plan financing, basically a giant credit card for cars. Steve, who runs a mid-sized dealership in Wisconsin, breaks it down like this. Every single car costs him about $2.70 per $1,000 in interest. Every day, it sits unsold. On a $40,000 SUV, that's more than $100 a month, just in interest. Multiply that by 200 cars, and you're looking at $20,000 or more, month after month, just to keep the lights on. It gets worse when interest rates climb. 2 years ago, dealers like Steve paid around 6% on their floor plan loans. Now, those rates have jumped to 9.5%. That's not a rounding error, that's a $70,000 monthly bill turning into $110,000 overnight. When cars were selling fast and prices were climbing, those costs didn't matter. But now, with inventory piling up and buyers pulling back, every unsold car becomes a financial anchor. Here's the part that most buyers never hear about. The bank doesn't just let dealers sit on aging inventory. Floor plan lenders set strict rules. If a car sits too long, the dealer has to make a curtailment payment, an extra chunk of principal, just to keep the loan in good standing. And if the value of the car drops below a certain point, usually around 125% loan to value, the bank can call in a margin call. That means the dealer has to pay up right now or risk losing the car, the credit line, or even the whole business. Steve describes it as a game of musical chairs. As long as the market is moving, everyone's fine. But when prices fall and inventory sits, the music stops. Dealers start slashing prices, not to win your business, but to avoid getting burned by the bank. He's watched friends in the business get margin calls they can't cover. One missed payment and the floor plan lender sends an auditor. Two missed payments and the tow trucks show up to reclaim every unsold car. This isn't just happening in one state. Dealers nationwide are facing the same squeeze. The average dealer now has about 76 days of inventory, up from just 40 days a year ago. That's a lot of cars racking up interest day after day. And with every rate hike, the hole gets deeper. It's not about making money anymore. For many, it's about surviving until the next month. So when you see a dealer advertising thousands off or willing to take a loss on a late model truck, it's not generosity. It's desperation. The math leaves no choice. Sell now, take the hit, or risk the bank pulling the plug. And as more dealers hit that wall, prices start to slide everywhere. The pressure isn't coming from customers. It's coming from the lenders, and it's relentless. Dealers are running out of time, and with each passing week, the flood of discounted cars grows. That's the hidden engine driving the used car market toward its breaking point. Repo trucks are working overtime. Lenders are seizing cars at a rate the industry hasn't seen in over a decade. 1.73 million vehicles repossessed in the past year alone. That's about 15,000 cars and trucks taken back every single day. The process is relentless and efficient. It starts with a missed payment, then a warning, then a tow truck in the driveway before sunrise. The repossession wave is not just a blip. It's the first surge in a much larger flood. 6 major asset-backed security lenders now control 93% of all repossessions. Their portfolios are packed with loans made during the pandemic, many to buyers already stretched thin. One banker, who asked not to be named, put it bluntly, "If the value drops below what we're owed, we don't wait. We pull the car. Every day it sits. We lose more." The volume is overwhelming local auctions. Lanes that used to see a few dozen repossessed vehicles now handle hundreds a week. Dealers, already underwater on inventory, watch the numbers climb. For every car sold at auction, 2 more arrive. It's a pipeline with no off switch. This is just the first wave. The repo stream is constant, and every vehicle that hits the block pushes prices down a little more. Lenders aren't just protecting their balance sheets, they're setting off a chain reaction that's about to hit every corner of the used car market. Lease returns that once fed a steady stream of late model vehicles into the used market are now arriving in a concentrated surge. The leasing boom during the pandemic's peak set up a cohort of cars, mostly SUVs, crossovers, and luxury models, that are all coming back at the same time. According to S&P Global, lease maturities in the first half of 2025 will drop by 41% compared to the previous year. That's nearly 1 million fewer off-lease vehicles expected to hit the market, just as dealers and wholesalers brace for a spike in supply. The premium segment is hit even harder, with a 46% drop in lease returns, while mainstream brands see a 39% decline. But the story doesn't end with leases. Rental car companies, after gutting their fleets during the 2020 shutdowns, have spent the last 2 years rebuilding. Now, as new car supply normalizes, those same companies are rotating out more than 2 million vehicles a year. Hertz, for example, offloaded nearly 200,000 cars after bankruptcy, then ramped up acquisitions as travel rebounded. With rental demand leveling off and electric vehicle experiments backfiring, the big players are cycling inventory faster, often dumping 12 to 18-month-old vehicles into wholesale auctions instead of holding them for the typical 3 years. This double wave, off-lease vehicles and rental fleet sell-offs, means wholesalers are flooded with late-model SUVs and crossovers, many with higher miles than normal and residual values that no longer match reality. J.D. Power projects that by 2026, electric vehicles will make up over 5% of lease returns, up from just 1.6% today, adding another layer of complexity for dealers already struggling to price aging inventory. With fewer buyers qualified for loans and more cars chasing fewer dollars, the pressure from lease and rental sources expands the glut that repossessions started. The result? A used car market where supply isn't just rising, it's converging from every direction. Dealer lots across the country are packed. The numbers tell the story. Average days supply has jumped to 76, up from just 40 days a year ago. That's not a blip. It's a backlog that's growing every week. In the $60,000 to $80,000 price range, the situation is even more extreme. Dealers in this segment are now sitting on a 97-day supply, the highest on record for this tier. Vehicles that used to move in a month now sit for 3. The overflow isn't limited to luxury SUVs or trucks. Mainstream models, from mid-size sedans to family crossovers, are piling up too. Inventory in the $20,000 to $30,000 range has stretched from a 32-day supply last spring to 61 days now. Each layer of the market is getting squeezed at the same time. Repo vehicles are flooding auctions. Lease returns, once a steady trickle, are now a coordinated surge. Hundreds of thousands of nearly new cars arriving in a matter of months. Rental car companies, after rebuilding their fleets, are now dumping vehicles back into the wholesale channel. The result isn't a wave, it's a tsunami. 3 million used cars are converging on a market that can't absorb them. Dealers, already stretched thin by rising floor plan interest rates and shrinking margins, are now forced to make hard choices. Hold on to inventory and watch carrying costs balloon or slash prices to move metal before the next shipment arrives. Many are choosing the latter. That's why deep discounts, $5,000, $10,000, sometimes more, are showing up on models that would have sold at sticker just a year ago. The glut is so severe that some lots have run out of room, forcing dealers to rent overflow parking just to store unsold cars. This isn't a slow leak, it's a sudden breach. Every extra day a car sits unsold, the pressure builds. The market can't clear this kind of backlog without a correction, and for buyers and sellers alike, the price reset is already underway. Flood-damaged cars are slipping into the used market at a pace that most buyers never see coming. Carfax estimates that 45,000 vehicles were damaged by storms between April and July alone. But the real headline is this: nearly 500,000 waterlogged cars, 482,000 to be exact, are already on U.S. roads right now. That's not just a coastal problem. These cars migrate. Florida leads the nation with over 82,000, but Pennsylvania, Illinois, and even California have tens of thousands each. Tidal washing operations move them across state lines, wiping away any trace of flood history. The paperwork comes back clean, but the damage is buried deep. Hidden corrosion in the wiring, mold behind the dash, airbags that might never deploy. On the surface, the deal looks perfect. Underneath, it's a ticking time bomb. The risk doesn't stop at hidden flood cars. Getting a loan in this market has become a gamble. The Federal Reserve's latest survey shows the perceived chance of being rejected for an auto loan has jumped to 33.5%, the highest since they started tracking. Lenders are slamming the brakes on approvals. Even buyers with decent credit are getting turned away or hit with double-digit interest rates. It's not just about the price, it's about access. For every 3 buyers who walk into a dealership, 1 will leave without a loan offer. That's a lockout rate the market hasn't seen in decades. The squeeze is everywhere. Dealers, desperate to move inventory, are less likely to check for flood history if it means a quick sale. Lenders, nervous about declining collateral values, are tightening standards and pulling back on risk. The result is a market packed with zombie cars, vehicles that look alive but are financially and mechanically dead. The traps are multiplying. For buyers, the risk isn't just overpaying. It's getting stuck with a flood car or a loan that can implode your finances. For sellers, it's watching good cars sit, while damaged ones slip through the cracks. When the market gets this crowded, the dangers aren't just obvious, they're built in. Every extra car on the lot increases the odds that something's wrong, and every loan rejection leaves another buyer on the sidelines. The flood isn't just water, it's paperwork, risk, and regret, washing through the system with no easy way out. Timing is everything when the market turns. The worst losses always hit first at the top. Luxury cars and high-end trucks are already in free fall, down 30 to 40% from their pandemic peaks. That's $25,000 or more, wiped off the sticker on some models before the first oil change. Meanwhile, compact cars and hybrids are holding up much better, dropping just 12 to 15%. The difference comes down to simple math. Expensive vehicles have farther to fall, and buyers for $80,000 SUVs are vanishing fastest. But the pain isn't spread evenly. In big cities, price drops show up first and hit harder. Dealers in places like Dallas, Atlanta, and Los Angeles are slashing prices weeks before rural lots even blink. That's because metro dealers swim in deeper inventory. more cars, more competition, more pressure from lenders. In rural towns, prices lag, sometimes by a full 90 days. If you're in a small market, that means waiting pays. The best deals always arrive after the flood hits the cities and starts creeping outward. The sharpest drops are showing up on vehicles that have been sitting unsold for months. Dealers are desperate to move anything aged past 90 days. That's your leverage. Walk the lot, ask for the oldest stock, and you'll see discounts that would have been impossible last year. These aren't just one-off deals either. National data shows that 97-day supply is now the norm on luxury SUVs and trucks. That's a record, and it's only trending higher. If you're thinking about buying, patience is your friend. The bottom isn't here yet for most segments. Late 2025 into early 2026 is shaping up to be the sweet spot, especially for anything over $40,000. For sellers, the clock is ticking. Riskier models, luxury, full-size trucks, electric vehicles should be moved sooner before the next wave of price cuts. Compacts and hybrids can afford to wait. They're losing value slower, and demand will stay stronger as buyers trade down. Every region, every segment, every model moves at its own pace. But the playbook is the same. Track inventory age, watch for regional lag, and pick your moment. For those who get the timing right, the coming crash isn't a disaster, it's an opportunity. Are you holding or hunting? Drop your plans in the comments. The next move could save you thousands. In 2024, over 1.73 million vehicles were repossessed in the US, the highest level since 2008. This wave, combined with more than 2 million rental cars and a surge of lease returns, has created an unprecedented oversupply. Consumers like Jason and Maria have already seen used car values collapse by $11,000 to $13,000 in less than a year. Dealers face daily floor plan costs of $2.70 per $1,000 in inventory, with interest rates up from 6% to 9.5%, forcing desperate price cuts. Yet key questions remain. How many flood-damaged cars will evade detection? Will credit tightening continue to block 1 in 3 buyers from financing? What's clear is that late-model vehicles, especially luxury trucks, are projected to fall 30 to 40% in value by early 2026. Compacts may drop 15%, and regional price gaps could widen. For millions of Americans, the used car crash is not just a headline, it's a reality reshaping household finances, dealership survival, and the entire auto market.